on the podcast this month since we came back after the holidays. We had our week in review yesterday with the mighty Mike Muller and Christoph Ruhl. And now we have the tripartite, London, Dubai, not Shanghai, London, Dubai, and Sydney. I knew there was an S in there somewhere, but let's kick off. Omar Najee, Global Head of Derivatives, BB Energy, anchor of Monday mornings. Omar, a lot of drama, obviously, but we end up more or less in the same place. Oil stuck to 110. Whether a little bit below or a little bit above, that's on Brent, of course. Your thoughts coming back out of the Eid, obviously, so the world was still fast engaged, but nonetheless, we were not. But still stuck at 110, whatever the news, this is a market that loves Brent at $110 a barrel. Your thoughts?
Yeah, so I don't think anything's, my thoughts have not changed. I think basically commodities, oil, need to push higher. I think, since you've had this Ukraine war, I think the world has changed. I think, you've had massive moves on currencies. I think you've had, massive moves in terms of geopolitics. Nothing is ever going to be the same again. And I think it's a kind of a slow kind of realization that eventually will wake people up. I think, it's like that old saying about a frog or whatever it is being boiled, so it doesn't notice until it's way too late. And I think that's what's happening to the markets. In terms of commodities, absolute massive boom. I think energy the same. The era, I think, of quote unquote cheap oil and gas and whatever is done. I think all this stuff with green energy and all the investment that went into it is also done. So I think there's going to be, lots of opportunities ahead. So I like the market. I was, strategically, long term, blah blah blah. I think buy.
Good morning to Peter Maguire, sitting in Sydney, Australia, of course, CEO of XM Australia. What's it look like from Asia there, with China hurting at the moment a little bit with the lockdowns? I would imagine that's impacting the outlook for Australia a little bit. Your thoughts on where China's at the moment and its sort of ramifications for the rest of Asia?
Well, good morning, Sean and panelists. China's been hit hard, and it's certainly been sold off at around about 1.3% today. So it's very, very soft. Understanding as far as those lockdowns, the impact it's having to GDP moving forward, the uncertainty. Aussie dollar's sitting at 70. It's cratered. Only a little while back, we were at that 75, 76 handle. So it's really been sold off heavily. The impact as far as we've got Hong Kong down 4 1/3% today. You've got Jakarta down 4%, the LQ45 down nearly 5%. So massive sell-off, Sean. A Monday mayhem. I'm looking forward to seeing what goes on across Europe when it opens in the next matter of hours, and how UK travels, and then naturally what impact that's going to show, because if this has been sold off so heavily, I'm sure that the NASDAQ will be sold off again, and the US equities. So it's not a good sign. We're being led in some ways by China, strong dollar, interest rates. Yeah, there's plenty of mayhem, but there's plenty of time to make a dollar as well.
Peter, just quick follow-up on that. The Asia wake up Monday morning, is it a simple sort of taking the lead from Wall Street and what we've seen there, or is the Asia story a standalone story, the China story? How do you separate those two in terms of sentiment and direction?
Well, I don't think sentiment, Sean, it's a globalized world, and they say globalization may be, dying on the vine, but let's assume that it's not. And let's say the interconnectedness of markets and logistics and supply chains, and we're seeing interest rates being ratcheted up, certainly with what we saw last week with Powell. And are we going to see 75 basis points in the next 2 months or 50? So the general theme is one of tightening, and we're looking at a lot of structural issues as far as inflation, high energy, high food. Have a look at the price of wheat, look at soybeans, what we've seen up best part of 25% in the last 4 months. So all of these impacts are being absorbed by the consumer, Sean, and that's global. So if food's costing more globally and energy's costing more globally, everyone is a victim.
Let's go to Ahmed Mehdi, Research Associate at the Oxford Institute for Energy Studies, sitting in London. Of course, Ahmed, the big story, I suppose, waking up Monday morning in Europe, as regards the oil markets at least, has been the developments regarding a EU embargo on Russian oil. Your thoughts on the outlook for that actually consolidating into policy and its consequences?
Yeah, good morning, Sean, and good morning, panelists. So I think that we saw that talks were breaking down, and the sort of limelight was on those countries which were far more dependent on the pipeline Druzhba flows, such as Hungary and Czech Republic and Slovakia. And I think that what that shouldn't overshadow is the fact that outside of those countries, there is the growing political momentum. And certainly, I think that what we have to understand is that I think it will be easier for some kind of sanctions landscape to take root on crude than it will be on products, and that's also being reflected in the sort of policy framework that they're putting forward with regards to the timelines. I think the second thing is, however, is that regardless of how the EU sanctions to take part in the talks go this week, already we have the financial sanctions in terms of that kicking in from mid-May, and I think we have to just be cognizant of what the Russian marketing has looked like in April. In April we saw a lot of redirection of flows. We saw Rosneft come out with more direct tenders and less. And that's really signaling the buildup of pressure, because there was a little bit of a wind down from trading houses, taking part in marketing term barrels, and I think that's one point. One point is about don't just look at the noise around the sanctions, the EU sanctions framework, but also just take into account the withdrawal of the trading houses. That will have a big impact. The second issue is also related to the insurance and basically complicating the Russian supply chain, increasing costs. Average ton-mile demand will go up, and a lot of that will be either reflected in even higher differential discount, or just a rerouting of or a rethink of how the marketing of those barrels will take place. So I think the pressure will certainly build up in May.
Omar, you talked there in your earlier comment about obviously the world has changed in all of its profound ways, but my sort of challenge to you on that is, what has changed? I mean, a lot of these developments are continuation of trends already in place. Oil has been moving east for decades; it continues to do so. The developments of, if anything, the story of the last 2 months has how little has changed. Russian oil still getting to the markets. We're still in 100 million barrel a day oil market, more or less. Where do you see the profound changes?
Let me explain. So first of all, everybody knows that the EU can't sanction or will not sanction anything to do with oil, right? Because basically, like in the case of take gas, right? So Poland said, we will not buy any Russian gas, or we won't pay for it in rubles. So Russia said, okay, no more exports for you. And then what does Poland do? It gets all its gas, Russian gas, from Germany. It just pays a high price for it, right? So let's be really clear. The market knows that Europe is not going to sanction anything to do with Russia, or if it does, it's basically for, perception, and they'll still be importing all the oil. But the market is going higher. Why? I'll tell you why. Because as Ahmed was saying, everybody is focusing on one side of the story. What the EU is going to do. The EU is going to do nothing. It's not what the market's looking at. The market's not looking at what the EU is going to do, because they've been saying they're going to do something for the past 3 months. What they're looking at is what Russia's doing. So what's changed, Sean, is you've got to now buy gas in rubles, and it's coming to oil and it's coming to all commodities that Russia exports. What that's doing is cratering the euro, skyrocketing the ruble, massive inflation, and just so that, people who are buying euros and holding them, the printing of euros is no longer going to buy you anything. The market knows that. The market knows there is no bid for euro. The world has a bid for dollar, but the world has no bid for euros. So that's gone. So what's changed is literally everything. Energy prices linked to ruble, yuan, commodities, all that stuff. So the Western media can say as much as it wants, we're gonna do and we're gonna squeeze and insurance and ships and we're gonna ban and all this kind of stuff. They said they're gonna do this, like this insurance, and these ships are gonna be banned. And yesterday Greece said we're gonna use the Greek fleet to load all this Russian oil. It's a joke. We're looking at the wrong thing. The market is not looking at what you're looking at. The market is looking at rubles. The market is looking at the euro. The market is looking at pricing for energy and commodities that has changed irrevocably and will never go back. And people just have their heads in the sand, which is fine. But, I think that's why I think prices are going to be going high, because you're going to have real price discovery. And you're going to have something that's priced in something that's kind of worth something, as opposed to just printed paper. So I think people are going to be surprised.
Obviously, Peter, there's a lot of things, Omar, is there cross-correlating gas with oil and sterling and euro and currencies and everything. But ultimately, the market is looking at other things than what's happening in Russia, clearly, because if we were, prices would be a lot higher. And China demand destruction is a very big story. I don't think you can open any newspaper in the world, whether it's Russian TV or, the Xinhua from China or the Financial Times, the demand side of this story is very much in the equation. And sort of my question to you is, can commodity prices, oil included, hold up when the economic outlook is, from much analysis, even Chinese Prime Minister acknowledging job vulnerabilities over the weekend? Ultimately, can commodity prices hold up at these levels when there's a macroeconomic outlook that is increasingly fragile?
Well, yes, it is fragile, Sean. We're all very mindful of that third quarter. We could see a kickoff as far as recessions in numerous economies across the globe, and that will only gallop ahead come fourth quarter and first quarter of 23. So there's the landscape there is not looking good. Secondly, inflation's got to be managed. Are we entering a classic? We've never seen times. I read articles like what Larry Summers was saying as far as the metrics, what's going on with inflation, what's going on with unemployment, interest rates. It is a pretty dire situation across many economies. If you only look at what's happening with the euro, look at what's happening, as you mentioned, with China. So yes, I think that the commodities will come back. I think they'll be violent in their descent, and I don't know when it'll happen, but I really think that we're setting ourselves up for a big short. US dollar will continue to climb and commodities will get hammered. So yeah, let's just wait and see how things move. But I think that there's going to be some very dynamic times ahead over the next certainly 6 to 9 months with commodity prices.
Ahmed, we particularly are seeing at this moment fuel oil tightness, diesel tightness all over the world, Europe obviously included. What's your outlook for that particular slice of the market?
Yeah, let me just very quickly go back to a point Omar was making. I think on the perception of the EU, we have to also put this into a bigger context, and it's in relation to your question. So I think even if you play with the timelines, exclude this country or, phase it out of this, it does come down to really, what does the market believe in terms of the reality of this happening? And I think certainly when you look at things like, the idea of removing Russian molecules from the European supply chain, it certainly has been difficult to digest, and particularly with regards to products. And I'll tell you why. I mean, just the 2 points on diesel and fuel oil. One, on diesel, unlike crude, where you can have some flexibility in procuring alternative grades. Urals is a base load for Europe. So even if you were to procure alternative, it's gonna, you may get an alternative with a higher sulfur content. But at the moment, the European refining system is really stretched, and actually operational costs have gone up significantly since the beginning of the year. High gas prices, high hydrogen prices, high electricity prices. And then, if you're going to get alternative grades, for example, you may even get higher desulfurization costs. So nevertheless, but at the moment, European refiners who are anyway adjusted towards, diesel yields, they are in a different position. All refiners globally are in a different position today than they were, a year ago, 2 years ago, where they had more flexibility to adjust. In this environment today, any shift of yields, which becomes the rebalancing tool in this market where you've got such tightness in products, basically just shifts the burden elsewhere, either on the gasoline side or the jet side as travel comes back, and also the driving season. So you've got this issue in the refining sector of basically there's no extra spare capacity except in China, and really the Middle East, but they have their own issues. In China, you have spare capacity, but you have product quotas, and we've seen record lows on record low gas oil exports out of China. In the Middle East, yes, you've got the potential for more Middle East diesel flows to Europe if they do phase out in a gradual way, but again, it depends on the timeline for these new expansion, like these projects in Saudi and Kuwait. On fuel oil, it's really actually completely ignored. And, I'm sure that, your panelists in the past have, like Matt Stanley and those others who work in fuel oil have talked about it. But it's a perfect storm for fuel oil, ever since the US embargo on Russian fossil fuels, including intermediate products like fuel oil and residue, the bottom of the barrel. Effectively, you've got Russian refineries have had to cut their runs because the US was a big market because they had coking capacity to take in that product, and that effectively has meant that now the US is now competing with Asia for those Middle East fuel oil cargoes. And we've got a situation where effectively you've got power generation season because of the high LNG prices. So places like Bangladesh and Pakistan are taking more fuel oil at the expense of LNG. You've also got the fact that you had this contaminated bunker fuel case in Singapore. So you've got some tightness there. And then to top it all off, you've got a situation where the Middle East is itself going to start a power generation season. So really, I think that the lesson of all of this across products is that it's effectively making supply chains very inefficient, and therefore all costs go up.
Let's get the survey question in with the outlook of what might be directing the markets in the coming 2 months that we're in, the rest of the second quarter, if you like. What will have the biggest impact on direction of oil markets over May, June? We're already obviously nearly 10 days into May, and we're still kind of stuck around, as I said at the beginning of our chat, around that 110 on Brent. China COVID lockdown, some days it seems to be getting the grip of the market. Other days, the Russian oil EU embargo that will or will not happen seems to get the direction of the market. Quantitative tightness, rate rises last week seemed to get the grip of the market, with more 50 basis points coming, or indeed none of the above. Which of these do you think will give an impact on the direction of oil markets over May and June? Perhaps I should have said all of the above rather than none of the above, but nonetheless, all of the above would have been too easy an out for everybody. Omar, just picking up on the comments earlier and Peter's sort of follow up, i.e., can your sort of bullish outlook for commodities and energy sustain through what does appear to be a growing clouds of economic slowdown?
Well, I mean, the growing clouds and COVID lockdowns and what else was it? It was like the demand indisputably in China's going down and all this kind of stuff, right? And all I've heard from panelists is that there's no product, refineries basically can't make it, and supply chains are stuffed, right? So my view is very simple. The market, oil market now is like the fuel oil market. Very simply, the fuel oil market became tiny. It became totally illiquid because so few people played in the fuel oil market. Before it was massive, then it became tiny. And that's what's happening to oil. You've taken out everything to do with investment and green and hugging trees and I don't know what and all the rest of it. It's becoming tiny. What that leads to is basically massive volatility. And what that leads to is complete and utter panic. So you can discuss as much as you want stuff to do with COVID lockdowns and I don't know what and blah, 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 and demand and will the US go into recession? But I'll tell you one thing, it's inescapable that all the Fed and the EU will do is basically ease more. The problem is they can't do it because inflation is rampant. But if you think that raising rates by 0.5 percentage point or 1 percentage point is going to make a blind bit of difference to inflation that's running anywhere, 10%, consumer price inflation into factories is probably twice that much. And what are we discussing? Will the Fed raise interest rate by 0.5 percentage point or 0.75? It's not going to make any difference. It's ludicrous. And yet we kind of say, will that lead to recession? Look at what's happened. Look at what's happened to the NASDAQ. Look at what's happened to equities. We had a massive bubble in equities. The US equity market is like, I think now like 3 times the size of the real market, if not more. It's never been that size in history. It's all basically built on paper and printing and all the rest of it. So I'll tell you one thing. Demand for oil comes from manufacturing, right? Which is in the East. Germany now has the highest cost of electricity, not for consumers, but for factories. Probably, I don't know, but close to in the world. It means their products are going to be absolutely uncompetitive. You think Germany is going to be happy with a euro that's going below parity? I hope so, because I think it's going a lot lower than that. And their problem is that their costs are going massively higher. So it's not like they're producing and the euro is going down. No, it's their costs. So the cost of buying a BMW is going to go from 100,000 to 500,000. Because all the input costs are going to go up. And then the euro is going to fall by 30%. So they're not going to be happy, I'm telling you. So I think oil demand holds up because basically people will want to heat and will want to stay warm and will want to cool. And I think basically that the East is so the idea being the West will pay $100 Brent plus a $50 premium. And the East will pay $100 Brent less a $50 discount, right? And, the media will say whatever it is, prices are high and I don't know what, and war and I don't know what, blah, blah, blah. But that's the long and the short of it. And I think that the euro against, the ruble and the ruble against the dollar, I mean, we're saying that the dollar's been extremely strong, right? Look at the dollar against the ruble. Look at the dollar against the ruble. It's gone from 139 to I think 62 last I looked. You're not seeing dollar strength. What you're seeing is a change, a complete and utter change in the global economy. And it's only the beginning. but again, people will stick their heads in the sand and say no, and all that kind of stuff. But we see
Well,
it. So let's see what happens.
I think that's obviously a big narrative, and if the ruble is, to the extent that it is a global currency, would have relevance. Obviously, it's a commodity currency, but Peter, looking ahead, obviously, in all of the things Omar is saying there, ultimately, he's of the view that oil and commodities, energy prices will hold through the economic cycle if indeed we see this continued slowdown. Looking at where that puts Asia, you mentioned at the top of the show the strong dollar, which is now above 104. For many economies in Asia who are buying commodities in dollar, who are also have their debt denominated in dollar with rising interest rates, what is their outlook vis-a-vis their ability to sustain economic growth?
It's going to be difficult, Sean. It's going to be difficult because you've got more attraction to dollar, and that will only increase, I think, over the next matter of months. So there was a very good article in yesterday's or the weekend edition of the Financial Times. We're back at 20-year highs. We last saw this sort of 104, 104.50 going back to 0201. So, and remember, that went, we saw a 118, 117 US dollar index. So are we, as if you listen to what Omar was saying, are we going to take an 80 handle out for euro, and what impact that's going to have naturally to the strengthening of that dollar and to Asia itself? So high interest rates, I think it's going to be a very, very difficult time for a lot of those Asian domestic economies to grow.
Is the dollar strength, Peter, in your view, a flight to safety? Is
Yes.
it obviously the outlook for US rates is more robust than others? What is the
Well, I think it's, yes, absolutely, Sean. It is a flight to safety. It's because you've got an aggressive J Powell. You've got US dollar sitting at 104. You've had very strong move to the upside, and the continuance of that, as most analysts are saying, over the next couple of months, certainly over the summer. So that return to US dollar, King dollar, is attracting all the traders, and the momentum at the moment is aggressive. So I can't see anything really backing down. I agree with what Omar mentioned as far as raising rates 0.5% or 1%. How's that going to solve anything as far as inflation? So, yeah, we're in a pretty difficult time. I think we're heading back to certainly stagflationary times, and that could be a global situation, far more aggressive than what we saw.
Peter, would you share Omar's view that Powell doesn't have the bottle to tackle inflation, and that they'll back away inevitably once they've done 2 or 3 50 basis points?
Yeah, I wouldn't be surprised, Sean. I think it's going to be very difficult because, it's all right to herald this. Remember, we spoke together last year at, August and September, and everyone was saying there'd be no rate rises in 22. Here we are, and Powell's off to the races. So he could get 3 under his belt, and then that's enough. Let's have a look at what's happening as far as global, as you mentioned, Asia, and all of those platforms need to work through domestic growth, what's happening with COVID. Yeah, it's a very difficult time to be a central banker, Sean.
Ahmed, just wrapping up, last word. Let's get the survey result. And in our voting, in our little survey here, we didn't even mention OPEC plus. Your thoughts, just wrapping up on the survey result, Ahmed, also, and on OPEC plus, currently irrelevant for the direction of the market?
Well, I mean, certainly. I think the market really, has known for a few months that it's been very difficult for OPEC Plus to play. There's basically a complete divergence between the sort of nominal increases and what we see, in terms of physical barrels. I think that in terms of those who are, obviously there's some political noise in the background. You mentioned it in your digest with this NOPEC issue. There's questions around how much real sustainable OPEC plus spare capacity there really is. Some of the countries, such as I think actually this is just actually not really taking into account what's happening elsewhere. So we're seeing, like, actually, from the beginning of the conversation, talk about, crude flows redirecting, and really it depends on where this story with Russia goes. So I think people just look at the OPEC-Russia relationship within the context of, for example, this monthly meeting, but actually things are already happening. We're seeing Middle East product flows move into Europe. Saudi had sent its, sending more diesel to Europe, particularly to Poland. You're seeing, players like Total, which have equity cargoes in the UAE, redirecting some of those flows to Europe, to their refineries. Likewise, Iraq, looking at sending more of the Basra medium, which is a good substitute for Urals, to Europe. So, things are already happening anyway. I think the question becomes, if this timeline for sanctions, the EU sanctions, is such that it does go forward, regardless of what other people may think, do players like the Middle East producers begin to think of, when it comes to November, do they start to sign up more term contracts with Europe at the expense of Asia? I think it's a genuine question within some of these Middle East NOCs. Should they start to, for years they were just looking at east of Suez market. Now maybe they will consider.
Just quickly, Ahmed, on that last point, Saudi OSPs published over the weekend with reductions on.
Yeah, I mean the reductions. I mean, I saw an article. People need to understand what the methodology for OSPs are. They're not just, there is a reduction because the market structure fell. So, it's completely in line with what happened with Dubai market structure. So Saudi OSPs, particularly for Asia and what have you, they fell in line with, with what was going on in the market, in the spot market. So it's not a political tool, as some people, journalists have written, or, they're trying to sort of take Russian market share, what have you. I think, as I said, as the year progresses, to be honest with you, the reality is the Middle East will be gaining length in distillates. They'll be longer in diesel, gas oil. So naturally, you would expect them to be playing. Everyone talks about crude, but actually products. The Middle East will be a far bigger player in the products market, and they'll be playing a bigger role in Europe on crude. I think, as I said, it's gonna be interesting what happens towards the end of the year, when you get new term contracts being signed up, and whether or not you start to see some Middle East producers allocate more barrels to the West than.
But certainly there will be a growing narrative in the second half of the year as we prep for next winter. I think, as was mentioned, I think Omar or Peter, of greater, or maybe it was you, Ahmed, greater competition emerging between Asia and Europe for gas and other flows that were typically going east for most of the last 10 years may now redirect. That whole redirection structure will be
yes.
a new narrative. Listen, we got to run there. Everybody's got to get back to work. Omar Najee has got to go back making lots of money. Peter, thank you so much. Omar, thank you as always. Awesome. Ahmed, thank you for getting up early in London this lovely spring morning. I'm sure you're getting the long days now. So all of your winter blues will hopefully be lifting, and you will have lovely summer days ahead.
Thank you.
All the best, everybody. We'll catch up every morning, 10:30 UAE time. All the best.
Thank you, Sean.
Thank you.
Cheers.